You check your portfolio. Silver just hit $108 an ounce for the first time in human history. Your mining stocks are up triple digits in 12 months. You feel like a genius. Then you look closer at the numbers and realize something terrifying. The metal went up 200%. Your stocks only went up 35%. You just watched the biggest precious metals rally of your lifetime and somehow still got left behind. Welcome to the gap that's making some investors millionaires while leaving everyone else holding companies that already ran. The metal hit escape velocity. Most of the miners are still on the launch pad except for 5 of them. These 5 actually moved. The question is whether you're buying rocket ships or expensive wreckage. We at Gold Silver Investing have spent the last decade analyzing commodity cycles and the companies that either profit from them or somehow manage to fumble generational opportunities. We have watched gold rush after gold rush. The pattern is always the same. The metal goes up. Everyone piles into miners. Half those miners are garbage. The other half are already expensive, and somewhere in the chaos, there's usually 1 or 2 that actually make sense. That's what we're hunting for today. If you want to understand where real money gets made in commodity cycles, make sure to hit that subscribe button and give this video a thumbs up, because what I'm about to show you is the difference between riding the next leg up and buying at the exact wrong time. Here's the setup. Silver hit the silver supply crisis, $108 per ounce, on January 28, 2026. First time ever. It's up over 200% in 12 months from around $30. Gold has crossed $5,500. Bank of America published a target of $6,000 by spring 2026. This is not a small move. This is generational. But here's what nobody's talking about. Mining stocks have massively lagged the metals themselves. Gold went up 60% plus in 2025. GDX, the big gold miners ETF, only went up 35 to 40%. That's a 40% performance gap. Silver's gap is even worse. The metal doubled and most silver miners didn't even keep pace with gold stocks. Why? Because the market got smart. It realized that higher metal prices don't automatically mean higher profits if your costs are exploding, if you're fighting tax battles with governments, if your production is flat, or if you're already priced like you're printing money at $70 silver when we were still at $30. Now here's where it gets interesting. There's a structural supply problem in silver that most people don't understand. Silver has been in a supply deficit since 2021. UBS estimates a cumulative shortfall of 796 million ounces. That's not a typo. Nearly 800 million ounces of deficit. Their projection for 2026 is another 293 million ounce shortfall. And here's the kicker. 70 to 80% of silver production is a byproduct of other mining operations. Copper mines, lead and zinc mines, gold mines, which means when silver prices go up, supply doesn't magically increase the way it does with pure play commodities. You can't just turn on more silver mines, they don't exist. The metal is trapped as a side product in operations optimized for other things. So you've got explosive demand, structural supply deficit, and a price that just went parabolic. Every mining executive on earth is now printing cash at these prices. The question is who's actually cheap and who's already priced for perfection. That's what the next section is about, because I'm going to walk you through all 5 companies, their numbers, their valuations, their leverage to metal prices, and by the end, you'll know exactly which one is the only genuine bargain left, and which 4 are expensive momentum trades that might already be over. Let's start at number 5 and work our way to the only miner on this list that's actually trading below industry averages. Stay with me here because the valuation story is where this whole thing flips. Number 5 is First Majestic Silver, ticker symbol AG. This is the purest silver play you can buy. 57% of their revenue comes from silver. That's industry leading. Most miners are 40% or less. They operate 4 mines in Mexico, plus a gold mine in Nevada. When silver moves, First Majestic moves harder than anyone. Maximum leverage to the metal. Sounds perfect, right? Here's the problem. The stock is already up 281% in 12 months. It's not that the company is bad, it's that you're late. Everyone who wanted exposure to a pure silver play already bought this thing, and now you're looking at a price-to-earnings ratio of 56 times. The industry average is 20. You're paying nearly triple for the same dollar of earnings. Add to that the fact that they're in an ongoing tax conflict with Mexico. Costs are rising faster than revenue. Sales grew 52.8% year over year. Sounds great until you see that general and administrative expenses grew 27.3% in the same period. That's margin compression in real time. Zacks Investment Research has them ranked number 4, which is a sell rating. Analyst consensus sees 4% downside from current levels, even with silver at 118. First Majestic is a great company. It's just not a great buy at 56 times earnings. You're paying for the move that already happened. Number 4, Hecla Mining, ticker HL. This is the largest U.S.-based silver producer. And if you think First Majestic ran hard, Hecla is up 390% in 12 months, nearly 4x. The company crushed the third quarter of 2025, $410 million in revenue, up 67% year over year, $90 million in free cash flow. At these metal prices, they're printing money. Here's why. Hecla's cash cost for silver is negative $2.30 per ounce. Let me say that again. Negative. They get so many byproduct credits from lead and zinc that they effectively get paid to produce silver. When silver was at $30, that was great. At $118, the margins are astronomical. Every ounce is basically pure profit after operating costs. They've got 2 major catalysts coming in 2026. The Lucky Friday mine expansion and the Keno Hill production ramp. Both should add significant ounces to annual output. This is a money printing machine at current metal prices. But again, you're late. Price to earnings ratio is 41. That's double the industry average. Analyst rating is hold, and most of those price targets haven't even been updated for 118 long silver yet, which tells you the street thinks it's already priced in. You're not buying future growth, you're buying past performance at a premium valuation. If you've made it this far, you're already ahead of 90% of people who just chase ticker symbols without understanding the numbers. But don't stop now, because what comes next is where we separate the expensive momentum plays from the actual value. Number 3, Agnico Eagle Mines, ticker AEM. This is the world's second largest gold producer. 85% of production comes from Canada. Ultra-stable jurisdiction, top-tier management. This is the blue chip of precious metals miners. Stock is up 127% in 12 months. Their all-in sustaining cost is around $1,250 to $1,300 per ounce. That's peer leading in the gold space. With gold at 5,500, they're making 4,300 plus per ounce in margin. Operating margins are over 60% record levels. They generated over $1 billion in free cash flow in Q3 alone. They're sitting on $2.2 billion in net cash, no debt problems. They've paid a dividend every year since 1983. Analyst rating is strong with 16 buys, 3 holds, and 1 sell. This is as much of a consensus as it gets. The company's executing flawlessly. Here's the catch. Price to earnings is 19 times. That's actually reasonable compared to First Majestic and Hecla. It's below the overheated miners, but it's still at the high end of historical norms for Agnico. And here's the thing you need to understand about gold producers versus silver producers. Gold went up 60%, silver went up 200%. If you believe silver has more room to run, Agnico is the wrong bet. It's a gold story, a great gold story, but you're not getting the same leverage to the white metal that's actually moving faster. Agnico's quality, it's expensive quality, and it's leveraged to the wrong metal if you think silver is the better trade from here. Number 2, Wheaton Precious Metals, ticker WPM. Now we're getting interesting. This is not a mining company. This is a streaming company. They don't operate mines. They don't have geological risk. They don't have permitting risk, labor strikes, or equipment failures. They just write checks to miners up front in exchange for the right to buy metal at fixed prices for decades. Stock is up 95% in 12 months. Not as explosive as the others, but here's why. That's actually good news. The valuation hasn't run as hard because the market doesn't fully appreciate what Wheaton locked in years ago. They buy silver at $5.75 per ounce. Current price is 118s. They buy gold at $473 per ounce. Current price is $5,500. These contracts run through 2029 and beyond, locked in, no renegotiation, and their contracted production is growing 50% plus by 2030. They've already signed the deals. The growth is guaranteed. EBITDA margin is 76%. No mining company on earth has margins like that because Wheaton doesn't have operating costs. They just collect metal and sell it. It's the most beautiful business model in the sector. Price to earnings is around 30 times. That's higher than Agnico, but way lower than the pure silver plays. Analyst rating is buy, 67% buy, 17% strong buy. Here's the tension. Wheaton is phenomenal, but it's not cheap. 30 times earnings for a streaming company is full price. You're paying for safety and locked-in growth. You're not getting a bargain. If metal prices pull back, Wheaton will pull back too, just less violently. It's the Porsche of precious metals investments. Expensive, but worth it if you can afford it. But there's one company we haven't talked about yet. the one that's up the least, the one everyone ignored because it didn't run 300%, the one trading below industry average valuations, even with silver at 118. That's number one. And this is the only name on this list where you might actually be early instead of late. Number 1, Pan American Silver, ticker PAS. This is the world's largest silver-focused miner. 10 producing mines across the Americas. They acquired Mag Silver for $2.1 billion in 2025, adding one of the highest-grade silver mines on the planet to their portfolio. This was a major acquisition that flew under the radar because it happened before silver went parabolic. Stock is up 33% in 12 months. That's the lowest return of the entire group. First, Majestic up 281, Hecla up 390, Agnico up 127, Wheaton up 95, Pan American up 33. The market treated Pan American like it was broken. It's not broken, it's boring. It didn't run because it's a large cap silver producer that was executing quietly while everyone chased the high flyers, which means you're looking at the only major silver miner that didn't front run the move. Here's the number that matters. Price to earnings ratio is 15. The industry average is 20. First Majestic is 56. Hecla is 41. Wheaton is 30. Agnico is 19. Pan American is 15. You're getting the largest pure-play silver miner at a 25% discount to the industry average at $118 silver with 10 operating mines, with the Mag Silver acquisition already integrated. This is not a speculative junior miner. This is not a broken balance sheet story. This is the biggest silver company in the world, trading like it's 2023. Analyst rating is moderate buy, 5 buy ratings, 2 hold, 0 sell. The street isn't screaming about it because it's not sexy. It didn't triple, but that's exactly why it's the opportunity. Let me show you why the valuation gap matters. At 15 times earnings, Pan American is priced like silver is at $70, but silver is at $118. If silver stays here or goes higher, Pan American is generating cash flow that the current stock price doesn't reflect. The market is pricing in either a collapse in silver or some operational disaster that hasn't happened. Compare that to First Majestic at 56 times earnings. That stock is priced for silver at $150. If silver stays at 118, First Majestic has to grow into its valuation. Pan American is already undervalued at current prices. Now, let me tie all of this together, because when you see how these pieces connect, the strategy becomes obvious. You've got 5 mining companies. All of them benefit from higher metal prices, but they're at completely different points in their valuation cycle. First, Majestic and Hecla already ran. They're up 281 and 390%. You're not buying growth. You're buying past performance at premium valuations, 56 times and 41 times earnings. Those are momentum trades that depend on silver going even higher just to justify where they are now. Agnico Eagle is quality, but it's a gold story. If you think silver outperforms gold from here, you're in the wrong metal. And at 19 times earnings, you're paying full price for that quality. Wheaton Precious Metals is brilliant. It's safe. It's got locked-in costs and guaranteed growth. But at 30 times earnings, you're paying for that safety. It's not a value play. It's a quality play. Pan American is the only one where the valuation hasn't caught up to the metal price. 15 times earnings for the largest silver miner with $118 silver is a dislocation. The market is mispricing the cash flow generation at these metal prices. Here's the psychological piece most investors miss. You feel smarter buying the stock that's already up 300% because it validates the thesis. It went up, so it must be right, but that's backward. The stock that went up 300% already priced in a $118 silver. The stock that's only up 33% hasn't. You're not late to silver. The metal just hit all-time highs, but you are late to most of the miners. They ran first. They always do. The move happens in stages. First the metal, then the miners, then the overvalued miners correct while the undervalued ones catch up. Pan American is in stage 2. It's the catch-up trade. Everything else is in stage 3, where you're hoping for an even bigger move to justify valuations that already assume perfection. And here's the thing about supply deficits. They don't resolve quickly. UBS is projecting another 293 million ounce deficit in 2026. That deficit has been building since 2021. You don't fix 5 years of underinvestment in 6 months, which means if you believe the structural silver story, you need exposure to a company that isn't already priced for $150 silver. The real question isn't whether silver miners will do well at these prices. They will. The question is whether you're buying companies that have room to run or companies that need silver at 150 just to stay where they are. Pan American has room, it's trading at a discount, it's generating record cash flow that isn't reflected in the stock price, it's got scale and operational diversity across 10 mines, and it just acquired one of the highest grade silver assets on the planet right before the price exploded. First, Majestic and Hecla might keep running if silver goes to 130 or 150, but they might also correct 30% if silver stays flat because they're already expensive. That's the risk you take buying parabolic momentum at 56 times earnings. Your future millionaire self is going to look back at $118 silver and ask whether you bought the companies that already ran or the one that was still cheap. The metal hit a record. The expensive miners hit records. The cheap one is still sitting there waiting for someone to notice that 15 times earnings with record margins is a gift. So here's my question for you. Where do you think silver goes from here? 150, 200, back to 70? And which of these 5 companies do you think has the best risk reward at these valuations? Drop your thoughts in the comments. Tell me if you think I'm missing something on Pan American or if you're riding one of the momentum plays and feeling good about it. I want to know what you're seeing that I'm not. The metal made its move. Now it's your turn.